Well, thanks very much, John, and thank you so much for all the organisers for inviting us to have this opportunity to speak. It's a critically important time. My background is I've been fortunate to cross paths with many of the people in the audience here today, so it's always good to be sort of refocused in terms of our collective efforts, and I think it is a collective effort, and again acknowledge the organisers to bring the kind of people together that we've got in the room today. It's a great asset that we have when we look at the people that can provide the knowledge and the solutions, and I'm particularly pleased to chair the panel today, which I'll introduce shortly. In my role at the Carbon Market Institute, I took on the role about 3 years ago, arguably a bad career move at the time when the Abbott government, or the Abbott opposition was rampaging and wielding a big axe over the head of the carbon pricing mechanism. I had the challenge to tell my wife that I'm going to be taking over the Carbon Market Institute. But the reason I did was, I think, because within the membership base, when I was offered to have a look at the opportunity, I recognised there were people like there are in this room that have hundreds of years of expertise in climate change and business that, if galvanised, synthesised, could provide a real, let's say, input into the policy-making process and to have some real influence. And we're lucky in Australia, for those who visit our shores, they are often surprised that we're only like 2 degrees of separation, or maybe 1.5 degrees of separation from any key decision maker in policy and corporate Australia. And so we have the opportunity to access and influence that. And people on the panel here today have actually played a very significant role in doing that and demonstrated that you know, like as Stephen outlined earlier, the people that are committed to a mission and a passion can actually have some influence. And so today, in this panel, we want to really focus on some of the opportunities that are going to arise from the transformation that's taken place. And our panellists, Greg Bourne and Emma Hurd and Ted Dow, I'll introduce shortly to give their opening comments. But we want to kind of try and have a conversation and really engage yourself in the next hour. I thought I'd just frame some of the discussion about where the opportunities are by some of the key takeaways from an event that we've heard a little bit about today, which was the Paris Conference of Parties. I was fortunate in my role to be able to attend an event which I thought was truly a historic event and really a diplomatic triumph. I mean, the French were masterful, firstly for holding it in Paris and not somewhere like Warsaw in December, actually got the world leaders there. The gathering of the people at the time and the confluence of the decision makers from all of the sort of 190 odd countries that signed the agreement was something that was really quite historic. And I think we will look back not just on that agreement, but also the Sustainable Development Goals that were signed in September last year, as 2015, as being a really pivotal year. So a few key takeaways. So firstly, I'd say the first one, this is particularly in the context of Australia, is that the debate is over. We don't need to have the debate anymore. I think that the trajectory is set. It's the big Coles hand. It's the trajectory is down. It's only going to go down, 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 further down. So in Australia, I think there's only one way for people operating under the Australian policy environment to sort of recognise, and that is the domestic policy settings are going to tighten. Leave aside the politics of it in an election year, we're going to see a tightening of domestic policy to align with our international obligations, and those obligations are going to steepen and deepen over time. The second key point, I think, is that the Paris Agreement is the mother of all market signals. Stephen said earlier today, which I thought was a great line, is that symbols send signals. And the Paris Agreement, I think, is going to reverberate for a long time in terms of a market signal. Thirdly, it was quite evident, and Emma can attest to this, is that the strength and depth of commitment of business and finance in Paris and the multitude of interactions into the policy-making process, into the negotiations process, was unprecedented. So that I mean, even our organisation, the Carbon Market Institute, we had 18 companies represented over there in Paris, up from one the year before in Lima, which was a big stretch. But those companies, you know, were the Qantases and Telstras and AGLs and South 32. So anyone attending that from Australia, I think, brings back depth of knowledge and contacts and networks and experience, but also a further understanding of the dynamics of the market that's taking place. Fourthly, I think it's the economic competition for the transition to a low-carbon economy is on. I know John kind of likes to point out that low-carbon economy is so 2015. It's really the no-carbon economy, so I'll take that point, John. But the race is on, and I think that was exemplified again by many of the different fora which anyone was there could sort of venture into, whether it was the OECD sessions or the IEA or the main plenaries. The one I used to like to go to every morning, which was in the China Pavilion, which you'd have very, very senior Chinese government officials, and they would talk to an audience half the size of this and lay out very specifically over the course of the day, these are our plans, these are locked in, these are in our 5-year plans, this is what we're going to do. And one particular session I thought was quite interesting was a California and China MOU session, and they had one of the Chinese officials through the translation was sort of saying, look, we're going to, we welcome our friends from California. We're going to cooperate with you, and we're going to partner with you. But make no mistake, we're going to compete with you. And then Jerry Brown, the governor of California, gets up there, he threw away the script and said, we're going to compete with you too, so don't you worry about that, we're going to compete. So didn't like that. And it kind of was like it resonated, okay, this is actually what it's all about. There's an economic competition in the transformation that's going to take place. And then to lead to the next point is that markets are going to evolve very quickly. There's a component of the Paris Agreement which is in the jargon is Article 6, and it really relates to how international trade in carbon is going to evolve. But it's basically a thin end of the wedge of bilateral arrangements and country agreements to actually transfer mitigation outcomes and monetise that. And this market is going to evolve very quickly. And I think if we're not in Australia sort of not attuned to some of those market dynamics and get it on the front foot, we're going to miss the boat in our sort of heavy fossil fuel dominated economy. And I think within the Paris Agreement there was some clear evidence of what that transformation is going to be, and that's what I'll be keen to talk and engage the panel about, is what are the transformations that are going to take place, where are the investments, and if you want to do some business development and look at this in a sort of comprehensive fashion, every country in the world submitted what was called a nationally determined contribution, basically a carbon reduction plan that they locked in. And if you look at those 150 odd plus things, it spells out, except for Australia's, mind you, it spells out in great detail what are some of the policies that are going to be implemented. And when you start lining them all up, you can actually see how is this country going to get to its carbon reduction or its emissions reduction outcome. And within that, you can start seeing where the investments, where the transformations might take place. Do that sort of broader analysis, particularly looking at our region, and you can start seeing where some of the investment trends might play out. And final point before I introduce the panel is that this economic transformation that's going to take place will not be managed by any one particular actor. It won't be within the realm of the UNFCCC, and it won't be in the realm of finance, it won't be in the realm of business. It's going to involve all economic actors. And I think one of the things that we get to in Australia is to bring those kind of economic actors together. And today, obviously, with the focus on the investment community, to try and understand and learn from what are the opportunities as this transformation takes place. We have a great panel to illuminate us. So what I might do is I might start with you, Greg, is to just basically sort of you introduce yourself, but maybe like 3 or 4 minutes of some opening comments, and then we'll sort of go down the line to Emma and Ted about what some of the issues and things you think are important to consider.
Okay. It's going to be literally just 2 or 3 minutes. So for me, I see 3 global conversations going on around the world which really matter. The first one is climate change and its sub-conversations about food security, water security, and so on like that. The second one is the global insecurity of supply of particularly liquid fossil fuels and possibly gas fossil fuels. And that's sort of code for what's happening in the Middle East is going to go on for probably decades. That insecurity of supply is going to be there as well. And the third conversation is about the technological leaps forward that's happening in the renewable energy world. And all those 3 conversations are unstoppable. They're decadal. And bring you to the fact that we are actually in an energy revolution which is just unstoppable. And it was interesting listening to Stephen Hines, and I come from an oil background originally, thinking about Rockefeller and how he saw the change from whale oil. I'd actually written the fact of whale oil change to oil. But just as you saw railways sweep away canals for example. You saw mobile phones pretty much sweeping away landlines. A lot of people lose a lot of equity as change occurs, and they resist like mad, but change happens. We are going to change. Second thing, in my time at ARENA, we always looked at change. My own view was what we were trying to do was to invest in the conditions precedent to cause a cascade of change, and you want that cascade of change. And again, it's one of the fascinating things to me, people talk about we have an oversupply of electricity. If you want change, you want an oversupply. You want a structural oversupply for a considerable period of time, possibly for a decade, if you really want to change. You want it structurally, so you actually need it. And so again, in ARENA, trying to cause some of that structural oversupply is something that we wanted to do and are actually quite proud of. So you think about it in terms of how do you bring disruption but with the solutions that are responsible, forward-looking, and responsive to what's actually happening. So the technological change and the commercial change were sort of built into the ARENA mandate, and I will happily still say that ARENA still has $1.3 billion in front of it to spend unless it is legislated away, and that very much depends on what happens at the election time. But at the moment, the one director of ARENA, and should there be more directors, will have a fiduciary duty to wisely invest that $1.3 billion unless it is legislated away. So watch the space after the election. ARENA's current portfolio of 250 investments is quite interesting. 150 are, let's call them research investments, so really at the early end of the innovation chain. 50 of them are what I would call developmental studies, where you're actually looking at what's going to happen which will cause this cascade of change. Can we look at a particular node within the electricity system which would facilitate, if change would facilitate bringing in more renewable energy? So investment studies. 50 would be titled 50 developmental projects, actual physical kit on the ground somewhere, and 5 pre-commercial deployments. What is interesting is, having gone through all of them recently and looking at them again last night, not one of them would have gone ahead without grant. So Ningen and Broken Hill would not have gone ahead without grant. Moree Solar Farm would not have gone ahead without grant. And CEFC wouldn't have loaned to Moree Solar Farm without that grant. So if in a country you want to stimulate the innovation, to stimulate that change, you've got to have this balance of grant, debt, and equity. And the great thing about looking at that innovation chain is it is coming along and it's moving along nicely. The interesting challenge to me, for you really, I suppose, is how do you reach into the innovation chain? You're not really geared up to reach into the innovation chain. You're more looking at what happens when something has already been built. But think of the Peabody curve and how value it was in terms of its market capitalization just 5, 10, 15 years ago, and where it is now. Reverse that curve. How do you get into the beginning of these companies so that you grow with them over 15 years? Thank you.
Yeah, terrific stuff to come back to, Greg. I will go back to the order, Ted. Okay, yeah.
Thank you, Peter. Sorry, I'm still getting over your imitation of an American accent, so I think I've recovered. I hope I don't. You sounded more like Ray Warren than Bob Brown, but maybe I've been in this country too long. So my name's Ted Dow. I was formerly the CEO of the Clean Energy Finance Corporation, at least until a couple weeks ago. Clean Energy Finance Corporation, for those of you who aren't familiar with it, has a $10 billion mandate from the federal government to invest in renewable energy, energy efficiency, and low emissions. Recently, there's been an announcement of a $1 billion fund in conjunction with ARENA to focus on the innovation end of the scale, which traditionally has been ARENA's patch. And traditionally, CFC is focused on later stage commercial return investments. We're not a grants organization, and that fund, I think it's appropriate for me to say, it's not a grant-based fund. So that is ARENA's role. I'm very pleased that the headline is Invest, because when I was asked to come to this conference that was about divest, well, I can sum up our divestment strategy from day one. We never invested in fossil fuels because we're the Clean Energy Finance Corporation. So I hope that's useful to most of you. But what we're all talking about here, and I think Greg alluded to it without putting a handle on it, I'm an economist by background. We're talking about the economic theory of Schumpeter's creative destruction. We're seeing an old industry torn down, and the change is coming. We all know it. There's consensus around it, and it will be replaced by a new industry. And we've seen that many, many times before, so we shouldn't be surprised by it. Although I think the notion of carbon risk is something that people have only woken up to very recently. It's only just recently hit the mainstream with groups like Citigroup and Blackstone, largest asset manager in the world, suddenly waking up to it. And I think if they'd really paid attention, taken it seriously, they would have seen it coming from a long way off. So what are we seeing in terms of, just as a synopsis, overview of investment opportunities? Well, again, you can see it coming from a long way off. For the last 20 years, clean energy, investment in clean energy technologies has run at about 24-25% since about 1990. What you do see along that trajectory is you see different technologies coming to the fore. And I think we're just getting to the point where we're seeing wind. Wind's still got a wonderful investment future, but it's probably reached its nadir. Its returns aren't going to quite normalize, but they won't be super normal as they have been in the past. I think we're entering the age of solar, and at the CFC, we've been very excited about solar. We believe, and I think the International Energy Agency agrees with us, right? To meet the 2-degree target, the International Energy Agency is saying that you'll need a 15 times increase in wind. That sounds like a lot, but you need a 60-fold increase in solar. So that's where we see the opportunity at CFC, and that's what we've been very focused on. Now, is that residential solar? Is that commercial solar? Is that utility solar? That depends a lot on government policy settings. Residential solar is fairly organic. It's enjoyed a pretty stellar run for the last couple of years, something like 30% per annum for the last 7 years. And for those of you on the divestment side, in the NEM, coal-fired generators where their incomes have dropped about 50% over the last 7 years, over that same time frame. There's a lot of other, that's a simplistic way of looking at it. There's a lot of other factors at work, but it does give you some insights into where we're heading. You don't need to look at the past to see that. So we're quite excited about solar. People are talking a lot about batteries. Everyone's very excited about the Tesla Powerwall, the Tesla 3.0 vehicle. We don't see batteries being economic unless you just need to be an early innovator. You need to have the latest iPhone, and you need to own the Tesla, because that's where you sit on the innovation curve. You're an early adopter. Today, batteries aren't economic. Cycle times aren't there. Recharge rates aren't there. But they're coming, and there's no question about that. How far away are they? Well, that's the age-old question in investment. Investing's very easy. You buy low, and you sell high. The hard bit is when do you buy low and when do you sell high. So batteries are definitely coming, and they will be an absolute and unbelievable game changer. Everyone can see that. We just don't know when they're going to arrive. And clearly the technology there is quite a bit more challenging than solar and wind. It'd be remiss of me not to mention, well, there's probably 3 more points I'll make, and then I'll move on. So I'm on a little bit of a roll. We can't forget about energy efficiency. No one talks about energy efficiency enough. And the best way to decarbonize your economy is to just use less energy. And why don't we talk about energy efficiency enough? Because you're not building a 100-megawatt power station like Ningen. They're granular opportunities. They're hard to find. I think at Melbourne City Council, you guys have done a very good job of finding those opportunities. They're there now. They don't depend on regulation. They don't depend so much on government policy settings. They pay for themselves. Energy efficiency is often referred to as the invisible utility. What is it? I'm getting a lot of blank faces. Well, energy efficiency could be more efficient manufacturing equipment, more efficient cars. It's really just productivity improvements, doing more with less. So let's not forget about energy efficiency, but you do have to work a little harder to bring those opportunities to the fore. The other unique opportunity that we have in Australia is the fact that we have a very, very large country, size of continental USA, but we've got about 5% of the population, so hardly anybody lives here, right? And where we do live, we live near the coast. We live in concentrated urban areas. So in remote Australia, they're powered by diesel. So diesel is something like $400 a megawatt hour. Solar energy, wind, batteries, they leave diesel for dead. The issue is that you've got to persuade people on a large mine or on a large property that they should give up their lead-acid batteries and their diesel generators, which they've probably relied on for a couple generations. That's difficult. But there's a huge opportunity and a compelling economic opportunity in that part of Australia. Two important points. I think Kobat alluded to it this morning. We live in a developed nation. We're going to overhaul our power infrastructure backbone over the next couple of years. The real investment opportunities in developed nations, if you really want to do some good, if you really want to make an impact, you need to focus on underdeveloped nations, which will grow their way out of this issue, and in particular Asia-Pac. You'll see 6 to 7 to 8 times as much investment in renewable energy in those countries in the world. And that's one of the reasons that I'm now the former CIO of CFC, is those are opportunities that I will be increasingly involved in, because that's where the real action is. Last thing, and I alluded to it, this is a long-term transition. It's 20, 30 years. That's how we talk about things in the power industry. So we need to make sure that the divestment side of the equation is mirroring the investment side. We need to make sure that for the next 20 to 30 years, we have oil and gas and coal available as transitional fuels. Because we don't, we'll see chaos. And if we see chaos, then all of the really good work that was done at Paris, it will come undone because people will feel pain. It will be a painful, chaotic change. And as soon as that happens, people sort of lose interest in it. And the pendulum swings the other way. So that's all I've got to say in terms of opening.
Terrific, Ted. We'll come back to that with your refined dulcet accent too. We look forward to hearing more. Emma's got a unique position in Australia to get visibility on a whole range of different insights and opportunities. So, Emma, please.
Well, one of the downsides of going last is everybody's already said everything you had written down to say. One of the upsides is you can get through your comments incredibly quickly. I guess, so I wanted to take a slightly different perspective coming from the whole of investor community perspective which we represent. So our members include both the very dedicated sort of ethical investment type firms who are explicitly targeting low carbon investments aggressively. We also have the big mainstream funds who've got all sorts of existing investments, large diversified portfolios, huge governance structures, a slow and deliberative process to decision making, I think is how it was described this morning. So I wanted to make just a few quick comments and go back to the actual conversation with the panel just to frame my perspective and where I'm coming from. So I think, as I said this morning as well, and I just want to reiterate, this is all about the transition. So the policy settings, the economic trends, the market trends, the technological change that's occurring is all about the transition. The transition from how we've been operating as an economy, as a global economy for the last 200 years, and how that's going to shift. Two things I'd make about this. The turn in that trajectory, the steepness of the turn is steeper than you think. This is not something that we're going to continue to debate for the next 15 to 20 years. This is something which is going to happen very quickly and all at once, so don't be caught unaware. Secondly, the pace is faster than what the investment community traditionally is comfortable with in shifting its decision-making, and particularly in beginning to invest in new technologies, new industries, new companies with unproven or unfamiliar performance ratios as well. So investors are going to need to get comfortable with making decisions in a faster way or in a different way than they have traditionally done so. And that is why it is so important that you have organisations like ARENA and the CEFC to actually play that sort of midwifing role in terms of getting the private sector involved in new types of transitions and new types of technologies, because you need those bridging mechanisms to actually meet the demands of the pace and the transition. This leads me to my second point, which is to also reiterate that there is no such thing as BAU. This is not like you can hide or return to the comfortable trajectories or pathways of traditional investments that you've been doing for a number of years, because they too are also impacted by the transition that we're talking about. It's not that you can just divest and then stay with the safe portion of the economy. You actually have to begin to increase your exposure to investments in new technologies to maintain a diversified approach to risk, because carbon risk is everywhere. It's in every industry sector, it's in every technology, it's in every asset class. You actually need to have a balanced approach to this, which pushes you to get more exposure to unfamiliar and new emerging forms of technology and change. And it also has to be acknowledged that investment is harder than divestment. It's actually easier to withdraw your funds from companies or from assets or from infrastructure pieces that you may think are wearing too much risk. It is much, much harder to increase your exposure to new investments and non-traditional players. But this is not something you can run from. This is something you have to find a way to do. Looking globally is another point. Peter made the point as well. I think also the expression that I quite like, which increasingly you hear the US investor community using, is the push for investing the INDCs. They are investment pathways. They are the areas of economic activity that will receive government support because they put them in their INDC or their National Carbon Reduction Plan. So that's a good roadmap for looking for where you should begin to be upskilling, building relationships, building an understanding of performance ratios, understanding who the emerging solid players are, and looking to work with other sorts of partners to get the investment flowing. And secondly, it's not just about decarbonising existing infrastructure in Australia, because most investors have actually quite a small percentage of their total portfolio in Australia. It is about the global investments. And if investing in clean energy in Australia is hard, investing in clean energy in jurisdictions where there's less carbon regulation, less carbon disclosure is even harder. So you actually also need to be looking for those sorts of areas of decarbonising growth. So investing the INDCs is about reducing, but it's also about investing for new, clean economic growth. And I think that's why you increasingly begin to see people talking about the Sustainable Development Goals, because you can't have decarbonisation without having economic growth in emerging economies as well. So being part of that solution pathway is key and is also potentially very profitable. The last point I would make is that carbon is, to some extent, it is and it isn't a black swan. It's actually a foreseeable risk. You know it's there. You know it's in your portfolio. You know you have to respond. So why not actually turn it into a golden swan and make it an investment opportunity rather than actually just thinking of it solely in terms of who you get out of? That would be my key message. And in order to do that, you have to find a way to make it fit your organisation. You can't transform yourself into something that you're not. You actually have to find the areas of clean energy or clean technology investment which suit your core values, your organisational purpose, your membership base, your investment position and policies and processes. So that's not impossible. It's hard, but it's not impossible, and it's potentially very profitable. So I'll leave my comments there, and I also look forward to hearing what the rest of the panel has to say. Thank you.
Thanks, Emma. I'm not sure if there's a fund manager with the Golden Swan Investments, but it's probably a good time. I'm going to just ask one question, but then I'll open to questions from the floor. And I think it's in the context of the transition that they've talked about and the transformation. Clearly in Australia we have some fairly embedded vested interests, and I would say in many ways governments of all persuasions have been go out of their way to support the investments in the historic fossil fuel-based, particularly electricity supply. So what needs to happen in Australia to effect an orderly transition? What needs to happen? Anyway, we can grab her.
Well, that's an easy question to start with. What do we all need to do? I think there's a couple of things off the top of my head. I would say, firstly, we need to take climate change from being a capital C policy dimension and make it a small c dimension of every other policy. I think it's not particularly helpful if you try and look at everything to do with decarbonisation of the economy in isolation from every other industry sector of the economy. So that would be my first point. And just embedding it and integrating it into the everyday conversations around policy development. The second one, which is very much related but more specific, is that we really, really, really need an integrated carbon and energy policy framework. I think for years we've been trying to talk about energy efficiency over here, the RET over there, ageing infrastructure over here, the job implications for communities over there, and we actually need to begin looking at this in a much more integrated and systematic way, because it's the same companies building the same assets on every front for a start, and secondly, it's just completely inefficient to be trying to solve this problem with one hand tied behind your back. So I guess those would be my 2 quick points off the top of my head to start with.
Thanks, Emma. Great.
Okay, so let me just spin off what Emma said. So one of the very first things I would do, following on for the next election, is I would actually take Arena CEFC out of environment and put it in Josh Frydenberg's portfolio straight away. It's been making sense for a long time, ever since I was with BP here. You know, it's been making sense all the time. You should put them all together. Energy efficiency, the low emissions technologies, and so on. So that's one of the things you do, and you do it really quite quickly. First cabinet reshuffle. Second thing is, I think orderly transition is the wrong phrase. It is not going to be an orderly transition. It is a disruptive transition. If you happen to be a market player who is going to lose 50% of your equity or 75% of your equity, that is not orderly, but that's going to happen. So I think probably from a politician's point of view is, how do you do it in such a way that the lights don't go out anywhere? And so South Australia is the first area you have to watch. And what is the speed at which the combination of demand management, renewable energy supply, battery storage, innovation, different types of contractual relationships, how do you make South Australia swim through 2017? That'll give more confidence as you go further forward. But don't think for one moment that it is an orderly transition. It is a disruptive transition, and therein lie the opportunities, but also the threats, hence the Divest Invest conference.
Yeah, terrific. Ted?
Yeah, I agree with all that.
Great.
No, seriously. So I'm going to say, I think we're all saying something pretty similar. We're just saying it in slightly different ways. And I guess it's a matter of what leaps out at you. What do you see? What is the most striking to you? And clearly what's pretty striking to all of us is, for this transition to happen, orderly or disorderly or chaotic, the less that we have a blueprint behind it, the less that we have careful planning and the right policies, the more chaotic, the more painful it will be. And I guess that's sort of what I alluded to a little bit earlier. And what leaps out at me, what strikes me, is that we've got an aging power infrastructure in Australia. We've got 80% of our power generation backbone. I say this wherever I go, whenever anyone will listen, but nothing seems to get done about it. 80% of our power generation backbone is fossil fuels. Okay, from a divestment perspective, you want to get rid of that, but that's not actually the issue. The issue is of that 60% is coal, very harmful most harmful form of fossil fuel. But within that 60%, you've got power stations that are older than a lot of the people in this room. You've got 20, 30, some say 50% of those power stations are past their useful service lives. So when are we going to get around to actually figuring out what is going to replace them? There's no debate, there's no discussion about that. People just seem to assume that it will happen. Well, that's 60% of our power generation backbone, right? So are we going to sit around another 20 years when they're 50, 60, 70-year-old power stations in operation? Or is there going to be a blueprint for change? And this is so apparent that the three big power companies who have the most to lose and want to manage this transition as carefully, and if you're a pure capitalist, as slowly as possible, so that they can maximize the cash out of their cash cows and not invest in the rising stars where there's going to be a bit more competition in renewable energy. Even those guys are now getting together and saying, look, we have to do something about this. There's a little bit of a policy vacuum. But you need a referee within that process, and the referee is the regulator, because you can be sure that the oligopoly of the big three are all trying to figure out a way where they can steal a march on their competitors, and they know it themselves. So to me, it's about planning and a blueprint for change. It's very much regulatory certainty, and another spin on that is I was in China earlier this year at the Bloomberg Shanghai conference. That's not a plug for Bloomberg, but, well, I guess it is, actually. But what was very interesting there is if you speak to people who are investing across Asia, you would think that Australia would be an easy sell. We've got the rule of law. It's nice here. People are friendly. It's sunny. We've got good beaches. Got the best solar wind resources in the world. It should be pretty easy, right? But what you hear is you hear people saying, nah, I'd rather invest in China. And you sort of go, well, look, I don't get that, because China's a communist, centrally planned economy. And they go, that's it exactly. Because I can get 20 to 30 years of certainty in China, right? I can't get that in Australia. And today, we have maybe 5 years of investment certainty for the power industry. That's the main thing that's got to be addressed.
Yeah, terrific. I'll open it up to questions. On the floor, there's a few over here. Tim, and if you just can remember just to introduce yourself to when asking a question. Thanks.
Duncan Patterson from CARE. I won't take exception to Ted's characterisation of the room as being past their useful life efficiency, like all that energy infrastructure. Seems they were all the same age as the energy infrastructure. I guess my question is twofold. One, and it's aimed primarily, I think, at Emma, with the... you can use both mics. With the current atmosphere in Canberra, do you see any encouraging developments with this upcoming election that we're all talking about, and possibly afterwards? And secondly, in your role as our champion and lobbyist in Canberra pushing for action in this area, I noticed that the Senate inquiry recently had supportive, Senate inquiry into carbon disclosure recently had supportive submissions from yourselves and happily from the FSC, but at the same time had some quite negative submissions from chartered accountants and from the Business Council of Australia. One of the frustrating things is seeing companies make statements about being progressive and green, and yet using their industry associations as proxies for inaction. So, interested in some of your comments about the halls of power and how much traction you're getting, and how much genuine movement is coming from the BCA and people like that.
Okay, well, I think I counted about 3 or 4 questions in there, so I'll whip through them. Look, I think it's actually really difficult to read where things are going in Canberra at the moment. And if anything, I would defer to more experienced hands here in terms of an accurate prediction. John, I'm going to throw the mic to you so you can give an accurate position. But I guess what I would say is that it's very hard to read where things are going, because there's, to some extent, factions within factions here. And also, we swung one way, we've swung wildly to the other, and we've come partially back to the middle, or have we? It's difficult to say at this point. Secondly, I think to some extent it's hard to say where things are going in Canberra, because to some extent the local politics have been overwhelmed by the tsunami of global politics, and so that's left some traditional players still working out how they ride that wave at the moment, in terms of traditionally well-held positions. And I think part of that shift has also been that there has been a business shift into more of a recognition of the need for some constructive policy frameworks here, rather than destructive policy commitments that we've seen for the last few years. So there is a bit of a shift going on there as well. Whether that moves well-held positions, cemented in positions of some industry associations, also remains to be seen. So I'm hedging a lot of my answer here, but I think we're in a state of flux. I think that one of the more positive things that happened last year was where you actually saw a coalition of industry associations coming together around the Australian Climate Roundtable, which included IGCC and the Climate Institute, but it also included the BCA, the AIG, the Aluminium Council, ACOS, ACF, a number of other non-traditional allies, actually calling for a more bipartisan approach to climate change policy in Australia. So there is definitely community appetite and business desire for a more reasonable conversation around climate change policy. In terms of how that translates in the election, anyone's guess would be the short answer. But the most important thing, I think, is that there is that commitment to the 2017 policy review there, and we know that in the latter half of this year that process will begin, which allows people to reopen and re-explore some of their positions as well. On the carbon risk issue, so for those who aren't aware, there's 2 things going on concurrently. There's the Global Task Force on Climate-Related Financial Disclosure, or the TCFD,
which is the global process which is being run by Mike Bloomberg, looking at industry-led and voluntary approaches to carbon risk disclosure. So that's looking at everything that everybody is doing, what works, what doesn't, how we get some standardisation and unification across carbon risk disclosure for both companies reporting and for investors using the data. Concurrently within Australia, there's a Senate inquiry which is just kicking off on Australian approaches to carbon risk disclosure. And having done an extremely quick squeeze through the submissions that have been put in there so far, and they were only due on Friday, which means everyone's handing them in today, basically what you're seeing is that we've got reporting frameworks there. We've got the National Greenhouse Energy Reporting System. We've got the Corporations Act, which requires you to talk about E.S.G issues. We've got some additional corporate governance guidelines from the ASX and some additional frameworks here and there, and none of them quite work in terms of what people need to see around actual carbon risk disclosure. So I think some of the strange positions from some of the traditional players have been based on the fact that they don't want mandatory reporting, but they're kind of open to the fact that something's not quite right there, so they put in extremely short and non-committal submissions as a result. Not that I'm being cynical, but that would be my reading of it. So I hope that answers all of the three or four questions that you put there. Thanks.
Yeah, great. Thanks, Emma. Question.
Frank Muller, Company Director. A number of the speakers, not only on this panel this morning, talked about energy efficiency and really made a plea, let's not forget about energy efficiency. And I'm struck looking, for example, at the chart showing how, of course, existing coal capacity is cheaper than any of our new renewables. But, of course, energy efficiency is cheaper than that. It's the best return available, but it's a hard sell. I mean, I myself a few years ago had to, at an infrastructure session at the Conference of Major Superannuation Funds, try and talk to people about the opportunities on the demand side of the meter. And for many people, I wasn't even talking about infrastructure. My question is, how do we make energy efficiency investable for big institutions? How do we realise we've known since Amory Lovins in the 1970s that a negawatt is cheaper than an extra megawatt.
I'm sure you have a view on this, though, because I believe ARENA is now funding energy efficiency, isn't that right?
Yeah, just quickly, so it's not actually in ARENA's mandate, but we're looking forward, to getting energy efficiency into the mandate. Funnily enough, it is actually in CEFC's mandate as part of the low emissions technology side of things. But to my mind, having lived in it again from a business point of view, working with you at different times, Frank, blind Freddie should say, just go and do it. But to my mind, about one of the only ways you actually do it is things like revolving funds. As a way of doing it. Because there's always something else to do in business which is sexier, much more fun. Build another one of these things, build more market share, whatever, and energy efficiency just gets left on the wayside. So you have to find a way in which you can get upfront funds. Now, it's been tried in Victoria, tried elsewhere, but it's long, hard graft. When I look at the energy efficiency of Australia, or energy productivity of Australia, whichever way you like to look at it, it is abysmal compared with, say, Japan. And part of it's to do with heritage. In Japan, not blessed with any resource, really, energy resource. Us blessed with too much. Ergo, after 40, 50 years, you end up with a different way. But it's one of those things we have to chip away, and it mostly lies within the policy realm, states and Commonwealth.
Thanks, Rick.
It's a very good question, and unfortunately I don't have a very good answer. Because the reality for the CFC is we really developed the energy efficiency side of our investment skill base when the renewable energy markets just weren't there, when there was all this uncertainty. And we knew that it was, frankly, the bigger part of the economy, represented in aggregate a bigger opportunity. And we had to regroup a little bit and really work a little bit harder to delve into the opportunities and frankly, even define what it was. That's part of the biggest problem. When I say renewable energy, everyone goes, oh, you mean wind, you mean solar, maybe you mean batteries, maybe you mean waste energy. But it's pretty contained. When you say energy efficiency, what are some of the things that we did at the CFC? We had about 35% of our committed portfolio in energy efficiency, right? Pretty proud of that. It would have been a lot smaller if we had been, from day one, just building Ningen or large large wind power stations or battery facilities or infrastructure. That just wasn't there. So, I mean, you're talking about, it's been alluded to, and I think actually if you look at Melbourne City Council, you can see how I think they've covered all of the basis in terms of what energy efficiency is. It's building upgrades, which is a real estate play. That's a partial, not property, somewhere between property development and owning A-grade buildings. You're buying a building, maybe it's fringe of CBD, you upgrade it, you reduce its energy footprint. What's a building? It's a box that uses energy. So you change its light bulbs, you change its elevator out, you reduce its energy footprint. In doing so, you increase its cash flow. Then you have a capital gain. It's funding the top 10 to 20% of the most energy efficient cars in the fleet. There's green vehicles, it's on the internet, it's put together by the government. We put together car leasing warehouses to fund the top 20% of vehicles as published in the Green Vehicles Guide. Now, unfortunately, at some point there were a few Audis and BWs in there. I think they've since been removed. But our intentions were good. So it's things like that, but I think that's the problem. People don't get excited about that because it's not nation-building stuff. It's a game about how to be more productive, and it's very granular. And the only way that I think you can really tap it is through SME lending at the end of the day, because it's things like chillers and cars and trucks and farming equipment and light bulbs and building upgrades. So there is no easy answer.
Yeah, that's a great insight into that kind of investment pipeline. We've got a question here and then to...
Yeah, John Ridley from Ocean Nourishment. My question's about negative emission technologies and carbon dioxide removal, and I'm just wondering how that fits generally with the divest invest community. So fossil fuel use could be prolonged if you could remove carbon from the atmosphere safely. Just wondering if you see that as something that should be heavily invested in now to smooth this transition, which is, as Greg rightly points out, is going to be very disruptive.
Let me answer that as well. It's interesting, when we were seeking to increase our mandate in ARENA, we said we could do energy efficiency, low emissions technology, and we could do carbon capture and storage, and we could do nuclear. We said we prefer not to do nuclear because the social license to operate argument within Australia might be a 30-year argument or 40-year argument. So leave that in the world of politics. On carbon capture and storage, which is one of the sort of bury the emissions, we basically said, we can handle that, but you won't like the answer. And basically, from an economics point of view, apart from a few special cases, it's not going to deliver what you need to do at this particular point in time. In terms of the more futuristic removal of carbon dioxide out of the atmosphere, funny enough, by far the best way is stopping deforestation on a global basis and starting reforestation on a global basis. That's the most efficient way of doing it. But some of the other technological wonderful ways of going forward, don't ever give them to an ARENA or a CEFC to look at, because the answer will not be liked by the proponent.
Thanks. Tim, that then.
Just a question on renewable energy being deflationary and energy efficiency being deflationary. How do you take a zero marginal cost competitor profile into account when you're investing?
Look, the reality is what we're, that's a competitive advantage and second to none. I think, to be honest, what we're much more focused on is the issue that's been alluded to many times today, and that's the fact that you're really competing with coal-fired power stations that have fully recovered all of their capital and they're operating at a marginal cost of $30, $40, right? And you've built something that, to repay its capital, is cost competitive at $80, $90 a megawatt hour. So that's a little bit more of what we at the CFC maybe simplistically focused on in terms of deciding how we were going to invest. But from a zero marginal cost of dispatch point of view, what it tells you is that the next dispatchable power in the merit order, well, you're always going to win against that, be that gas or, we used to have peaking power plants in Australia. We don't anymore. Surprise, right? And I don't think we will anymore, because you don't need that peaking power anymore. You don't have the price spikes that you used to have, albeit when your interconnector goes down in Tasmania, or you're seeing South Australia and their interconnector isn't sort of delivering the capacity it needs to, ironically, import brown coal-fired power station electrons from Victoria, then you do see some issues. But we're much more concerned about the fact that when you look at investing in a commodity, and electricity is a commodity, and it's one of the worst types of commodity because you still can't bottle it up and ship it somewhere else where someone will pay more. It gets dispatched, and if it's not used, it's wasted. And that's tricky. So it's one of the most volatile commodities in the world. When you look at that, when you look at any commodity, how do you protect yourself? You always want to be in the lowest cost quartile. You always want to be with a guy who's producing the cheapest power. Well, who's that today? That's the coal-fired power stations. We can't invest in them for a number of different reasons. So that was really more of our focus. It was a little bit of a different focus.
I've got about 15 questions that I'd like to ask, but I'm going to do my job and try and keep the program on track. So we'll take one more question, and then I might invite the panel to give some closing comments.
I suppose this will be quick given the time. And we talked about divestment, and here we're talking about investment. In divestment, we clearly covered more companies than just Australia. I feel that this investment section has been focused on Australia and direct investment, which has different analysis and different investment risks. I think it's important to also acknowledge that there are investment solutions in the global space through listed equities where there are already these research and indexes that identify companies that have revenue exposure to energy efficiency, renewable energy, pollution prevention, and sustainable water, for instance. Emma, you're probably more exposed to this given your role with Investor Group on climate change. Do you see that there are more investments globally than we have in Australia, and that these are options that people in the room should consider as well?
Yeah, look, I think I made that observation in my opening comments that from a portfolio perspective, definitely global investments are a larger component than Australia, and we have been talking about Australia because also, I think there is investor appetite to find good Australian projects to incorporate into their portfolio as well. But definitely, I would say don't let some of the particular issues of the Australian jurisdiction put you off the fact that globally there are more significant opportunities. I wouldn't necessarily paint it as a halcyon picture of investability out there, though, either. A lot of the issues that are particular to Australia are not unique. We're just dealing with them in a somewhat troubled way. So, in some senses, there are the same sorts of issues around competing with existing players, around cost of technology, around getting secure financing arrangements in place on the other side, those sorts of things. But there are definitely an emerging world of low carbon finance products or investable products which are increasingly emerging. I think I did sort of make the comment at the beginning that we are increasingly taking a role in trying to showcase what some of these opportunities are, because we frequently get asked, where are the opportunities? Where are the positive opportunities? So part of what we've tried to do in collaboration with the other investor groups of our type is build that low carbon investment registry. So I would do a bit of a blatant plug here and say, if you've got investments that you want to have profiled that are ways that you found of solving particular issues, let us know and we'll put them up there. But also I would recommend going and having a look there at some of the ways that different funds from around the world are actually building products and services to tackle this particular issue as well. There's some quite tangible, practical examples there that are worth having a look at as well. One last point that I would just make is the bit that we haven't talked about here is green bonds, and green bonds is a good it does a few things in terms of the conversation that we've been having so far. It bundles up and gives scale to some of the smaller, more granular types of opportunities we've been talking about, like energy efficiency in the property sector or in the energy sector. It gives scale. It's more. I wouldn't say it's easier, but it's easier to get past the investment committee approval process. There is emerging pathways and frameworks around proving up the greenness or the environmental aspects of it, and it does tend to fit in traditional investment approaches as well. So green bonds is something that I would definitely also recommend going to have a look at in terms of some of the significant growth that we've seen there as well.
Can I, Peter? Can I just respond to that?
I think you just answered the question over there before, because one of the wonderful things that we find about green bonds is, and a lot of them are energy efficiency. Toyota's issued a few, for example. They train you to recognize and to understand what the energy efficiency opportunities are. And not only that, you have to make an investment in systems to track those opportunities. That's really where I see green bonds as being incredibly powerful.
Lily, you're going to disrupt my management of the time, but go ahead, yeah, please.
Response to Michael's comment that part of the Divest Invest movement or campaign is to shine a light and to support a transition domestically, which Australia really needs. So I think that was the reason why, from plenary and planning perspective for this conference, we really had to try and tease out what the Australian landscape was offering and what was over the track, so that we could get some catalytic capital helping that pathway and that transition. So that was the reason for this kind of programming.
Oh, great, thanks, Lou. And look, so I might just ask each of the panel, let's start with you, Ted, just a final thought, maybe something to leave for, particularly I suppose for the investor community, sort of like trying to grapple with this now. What's a final parting thought or comment that you'd like to leave, and we'll just ask each of you to give a brief comment.
I don't know if I have any original ideas left. So you could have started with those guys, and I could have stolen one, actually. But look, again, for me, the thing that I think, I'll say it again, what's been achieved in Paris is phenomenal, and the whole debate's now changed. And the climate skeptics have lost their position at the podium. And that's great, because there's a huge and pretty unified international agreement to move ahead with decarbonizing the economy. So for me, I think now it's about understanding how to plan that out, how to make sense of it so that it's not too disruptive, because you can see examples of that in Germany. Germany is a global leader. But right now, if you speak to people who are from Germany, they're not feeling too good about the fact that their power infrastructure predominantly comes from renewable energy, and there have been some perverse outcomes. There's been coal and renewables pushing out LNG and gas, which is a low-carbon form of fossil fuel. That's not a good outcome. And you look in our own countries, Tasmania and South Australia, they're world-class in terms of where they draw their power from, the percentage of renewable energy. That's causing them a spot of bother right now. Power prices in South Australia are incredibly volatile, and that's perhaps something that hasn't been thought about in the planning. Tasmania, you talk about a long-term plan. Well, their short-term plan didn't factor in the reality that they might run out of water for their hydroelectric facilities, and that their interconnector would break down. And what are they doing now? They're importing diesel power supply. That's incredibly expensive, and it's the bipolar opposite of what they're trying to achieve. So for me, it's about the planning, and that's how that's going to come out. I don't think any of us know.
Thanks.
I think I'd have two tiny quick points. One is that I think one of the areas that we've potentially missed in our discussion around investment opportunities is a somewhat depressing opportunity around adaptation finance. The fact that we know we have a certain amount of warming locked into the system, and there are an awful lot of fixed assets that we'll need to increase their resilience to the actual impacts of climate change. So looking at opportunities to integrate adaptation considerations into existing finance structures, or actually looking at potential for new adaptation finance structures is one area where I think there is a lot more work to be done, sadly. But secondly, I think I would just reiterate my point from my opening comments that, again, there is no such thing as BAU anymore, and that you have to find a way to make this work. I mean, you can't choose not to act on this. If you can choose not to divest, but you can't choose not to invest, you have to find somewhere to put your money, and in which case you really do need to find a way to begin integrating these considerations into your ongoing investment activities and mandates in such a way that suits the way that you work and the way that you operate. You've got to find a way to make this work for your organisation, basically. So a small challenge there, and then I'll hand over the mic.
Okay, thanks. Always interesting to have the last spot. Ted mentioned earlier on, solar and wind are going to win. They are just going to keep going. But the area that I am most interested in really is the distribution network service providers. If they were unshackled from the current shackles that they have, they are the ones that are closest to all customers, by far closest to all customers. And together with, people talk about batteries, but it's really battery storage and ancillary services. When you get battery storage and ancillary services together with renewable energy, cracking the ability to supply all of your customers really, really well becomes very important. That actually unlocks how you power Africa. It unlocks how you power Asia Pacific in many of those countries. So it's that mix to me which is the most interesting area. So whether it's a supplier into those services or it's one of those companies which begins to grow bigger, to me that is the area that I find the most interesting of the lot.
Well, look, some really terrific insights. Thank you very much. Can you please put your hands together for our panel, please?